afternoon. On the day of 21st of August, we are trying to give a very simple analysis on gold and silver prices. Lots of noise around today's FOMC minutes, and practically everybody is worried whether they are going to start tapering off or not. Now, as central bank job is to really assuage the expectations of the market, and market participants are in constant tussle to preempt what central bank wants to do. It provides all kind of uncertainty, vis-a-vis volatility, if you speak in market terms, and this volatility gives some people opportunity to make money, and some people actually go broke. But these are the best times to trade, and so we try to put a very simple hypothesis of what can happen to gold and silver prices in a medium term. When I say medium term, I mean to mean like a 6-month period, 6 month to 1 year period, 1 year period. So here we go. The first thing is that a very simple analysis. Crisis came somewhere on the shores of the global arena in about 2008 March. Bear Stearns had a fallout, was sold on a platter to JP Morgan, and what we are witnessing here is a silver monthly chart right from 2000. So there were no price movement and nothing to talk about till 2006, and this was like a peak before the crisis, and this is a month, particularly this is a month where Lehman go broke, and this was the Nadir, and the Nadir was somewhere around $8, few change here and there, and this was the time period somewhere here where QE1 was announced, and the prices then really after the announcement of QE1 the prices moved to the same level. And what I am suggesting is that at our Jackson Hole meeting in August 2010, to be precise on 27th August 2010, Mr. Ben Bernanke gave indication of QE2, gave an indication of QE2, and from there was a breakout. It was August. Actual QE2 was started in November 2010, and so you can see in 7-8 months the prices go berserk from $20 to $49, and so it was a beautiful trade somebody would have taken on, and these are the technical. This was a breaking of the range, and I will not delve much into it. So what we are witnessing here at present is prices came and took a support at the same level around which QE2 was announced. Good for now. I will look into the gold chart, and what we are finding here in the gold chart is again the same thing. This was the period at the level of around $1180 or $1,200. Mr. Ben Bernanke hinted for QE2, as I was saying in the silver chart. This is again a monthly chart, and so from here the prices moved up, and prices actually found a support at the same level at which the QE2, around which the QE2 was announced. This is a beautiful symmetry, as both silver and gold comes into the precious metal class, and we are able to find some kind of congruence in the price action of both. As somebody rightly said, you can't find an intrinsic value of gold and silver. Mr. Warren Buffett rightly said that gold doesn't give anything, but then gold is not an asset of normal kind. Gold is a kind of currency, silver is a kind of currency, and American monetary history is loaded with much of what happened with a bimetallic thing, or whether it is something else, which I will not delve much into it. So one key takeaway that we are trying to take from this video is prices are at the same point where QE2 got announced. It actually not came into picture, it actually came into force somewhere around in November 2010, but it was announced, hinted on 27th of August at Jackson Hole lecture in 2010. Fantastic. So kind of incongruence and prices we hypothesize and practically believe it should not come down. That means that the low has been already made, and that is what we have to watch. So that is what we are proposing here. Now, one of an important thing that we want to tell here is that what is the difference between a QE1 and a QE2? If we can understand between a difference between a QE1 and a QE2, we can assume that the prices will not go to the level of QE1 and will remain stuck at the level of QE2. So what we are mentioning here is basically QE1 came into force to cool off the markets, in very common sense, in a layman terms, cool off the markets. Somebody has to be a buyer on the other side. So Federal Reserve came out, expanded the balance sheet by somewhere around $1.3 trillion at various stages, 2 stages in general. And so it was about giving market liquidity, helping economy not to go into depression and so on. So what we are finding here is that the level before QE1 and the level after QE1 practically remains the same, particularly in silver if you find, particularly in silver, but in gold it remains the same. It remains a bit off, bit above. So at this level was around 1000 level, and 1200 was the level that was around August 2010. So if we say that because of the crisis and because of the QE1 the effects are okay, fantastic. QE2 was something abnormal, but we can even delve into why QE2 was there. QE2 was essentially different from QE1, and QE2 was to make long-term dated securities yield to go down, so that other assets which are of the same nature could have the same yield, and that we are talking about the home borrowers or something like that, so that they have to pay less interest on their borrowing cost and they can actually afford buying a home, and this will actually inflate the prices of the assets and put the economy on a better footing. So that was the cause of that was the basic underlying result that QE2 was to give. And so what we are saying here is that in a simple layman term, that QE2 was there to keep the interest low and to inflate the asset prices. So the asset prices inflated. Everything went berserk in QE2, whether it is Indian markets or whether it was S&P, everything went berserk after the hint of the QE2 announcement. So gold and silver prices are back to the QE2 level, and so it doesn't affect. My hypothesis is this, our hypothesis at MCAP is that it doesn't affect whether the tapering is there today, or in the FOMC minutes that they are going to taper soon or they are not going to taper soon. So what we are trying to say is that whether taper or not taper, gold prices and silver prices have made their bottom, and we will try to look forward what happens. So there are two scenarios. Obviously nobody is going to talk about that they are going to taper off, not gradually, instantly, nothing like that. On a dime they will turn things, not at all. They will try first of all to test and will give strong hints that they are going to taper, and second is that they will loosely concord theories here and there, and they will not taper in the last quarter of 2013, but they will try to come up with a calendar first quarter or second quarter in 2014. So these are two distinct scenarios. They taper early in September 2013, or they taper around in 2014 or so. We take the first scenario that they taper in 2013 September. So what happens is, if they do taper, the bond yield will rise as it is already rising, and the 30-year bull run in the bonds will be coming to an end, which assumes that the nominal interest rate will rise. So what happens to inflation? This is a big billion-dollar question. Nobody has an exact answer to it, and so we will leave it there. But we will assure that the bond yield will rise first. So the real interest rates will be something of a nominal interest rate are risen. We don't know about inflation, so we will assume that the real interest rate will rise or will not rise, depends on the inflation. The second thing that we take is they taper around in 2014 first quarter or second quarter, which will have an implicit exploding effects on the prices of gold and silver. Look here how they don't taper. That means that economy is exactly, they will taper, but they are not tapering down, so they have an intention and economy is doing fine. When QE2 was announced, unemployment rate was somewhere around 9% plus, north of 9%. At present it is around 7%. So it is, as far as economy is concerned, as far as employment is concerned, under the conclave of economy, we are doing better, and so inflation will rise a bit, what you can say, faster, and so the inflation will rise, and so what we can pick up is that gold can become an hedge, and so on. So if they taper around in the next in the first or second quarter of 2014, there is no clearly takeaway of cheap money or so, inflation around the corner, nominal interest rate will still rise, real estate interest rate remains low, perfect ground for gold moving up. So in the second scenario, that if they go and give even a hint that there's tapering is around, but only after Mr. Bain Bernanke goes out, and it will have a good effect on the gold prices. That means a positive effect on gold prices, and gold prices we can assume a base in any scenario at around 1345 to 1350. So we come back to the first scenario that they taper around in the last quarter of 2013. We are not very much sure. If inflation is also rising, there are real interest rates are very low, and so gold will follow the suit on upside. If inflation is not around the corner and bond yield rises, there is one important thing that we will say, that if bond yield rises, bond investors are not going to invest, they are going to take money from the bond, and it will be like I do first and you do second kind of thing. So there will be a rush to take out money from the bonds and even from the stock, because if the nominal interest rates are rising, these are not very good times for investing in stock, and so the money will come out from the bonds, they will come out from the emerging markets as we are seeing in the Indian markets, and they will come out of the bonds. And so the question is where the money will go actually. And with China buying and with the Asia buying thing on the golds, they are buying gold, probably we feel that money can go into the safe assets like gold and silver, and so they will keep on rising. Another few fundamental facts, that there is still backwardation in the gold market, and this is one very important bullish factor that is working in favor of gold. And there was a report last, which I will say because we are talking a bit technical here, but then we have to take on it, that we are talking that there is a great shift of gold from London market to Switzerland market, somewhere in the region of 200 tons and so in the last month. So all these things are putting something of a kind, except for inflation, which we are not able, which we will try to come and beat the inflation thing around in the next video. Our house and our research, it is a firm believer in gold prices going up from here, and if particularly in gold prices remain above the level of 1345 or so in today's night or tomorrow morning, we are looking for targets of around 1420 to 1450 in the coming 6 months. Thank you.